Is this approach of all-time highs a chance for investors to cash in, to break even, or confirmation that a young bull market is gathering steam into 2024? Let's ask 314 Research co-founder Warren Pies. Warren, it's great to have you here. How you doing?
I'm good. Thanks for having me.
Sure thing. Now, you know, the story for this year, I mean, you could have said it a year ago, but it was, can inflation go down more quickly than the economy loses steam? And that has certainly happened to this point. We now seem to have kind of seen a Fed pivot rhetorically, if not in reality. Where does that leave you in terms of what we should expect, at least in the first part of next year?
Yeah, I think that we try and be data-driven at 314 Research. And so the data points in a bullish direction. It's hard to kind of deny that at this point in time. You end up with a few just broad axioms that we live by. Don't fight the Fed. Well, the Fed's now stepped aside. And if you remember, we talked earlier this year, and one of our problems with fighting the tape back then was the tape signals aren't as good when the Fed's in your way. And so now the Fed's cleared the path. You can trust the tape more. So we're seeing a broadening rally. We see, even though there's a lot of bullishness in the market, it feels that way. When I look at it objectively by the data, economists are still kind of on the fence on a recession next year, and strategists are far from bullish. I mean, at this point in time, the average strategist target for 2024 year end is implying less than 1% gain on the S&P 500. So I think this kind of sets up for this big bullish chase. We upgraded equities in November with the idea that everyone's going to be behind the eight ball and need to catch up. And I think that's what's happening right now.
Yeah, it does seem as if a lot of those things you mentioned, plus just the run of macro data and what's happened to bond yields, has really turned the burden of proof back over to people who think the economy is in some serious trouble in the near term. How do you think the market, though, trades with respect to what the Fed might do, just exactly how the numbers have to come in, the data have to come in order to get the Fed continuing to, I guess, be more of a tailwind than a headwind?
Well, I think we have to go back and study history a little bit. And unfortunately, soft landings that's our base case, but they're relatively rare. But the one takeaway that I see when I study history of soft landings is that the market rallies aggressively in anticipation of the first Fed rate cut. And that's a little different than hard landing cases. And so the average case sees a 10% return in the market in the 6 months leading into the first Fed cut. And so I actually think that's going to hold this time around. I think that points to a kind of crazy sounding target that we put out there a little while ago of 5,200 by May 1st Fed meeting. That's when we expect the first cut. So sounds crazy, but I think that keeps the pressure on these strategists who have yet to increase their targets. And we have this kind of perfect bullish storm here in the first part of the year. The other thing I would say, I think every strategist is looking to last year after getting burned on their recession predictions, and they want to get back to normal. And normal is like 8% return, and they go through and check all their boxes, and they think presidential election cycle says weak first half, strong second half. I think you could flip that entire script on its head, where we have a strong first half and then a weak second half next year, as everyone has to catch up and is behind the eight ball.